All right, let's talk about a company that is a total battleground stock in the fintech world, SoFi. You know, some people think it's the future of banking, while others say it's just another overhyped startup. Well, we've dug into the research, and we're going to break down both sides of the argument, starting with one single, really eye-popping number.
So what's all the buzz about? It really starts right here. That's SoFi's revenue growth in 1 year. You gotta ask, how is that even possible? Well, to get it, you have to look under the hood and see how this business is actually built for this kind of insane growth.
So how in the world does a company pull off that kind of growth? Well, it's not just one thing. SoFi's whole strategy is built on 3 different pillars, 3 core engines that are all designed to work together and, accelerate each other.
Okay, so here are those 3 engines. First, you've got lending. This is their original business, it's mature, it's stable, it makes money. Then you have financial services. This is the rocket fuel, right? This is the growth engine pulling in millions of new users for things like everyday banking and investing. And the tech platform? That's kind of their secret weapon. It's a B2B service that basically provides the plumbing for other fintech companies. But here's the key part. They are deliberately shifting their focus away from the capital-heavy lending business toward these other 2 because they're way more scalable and profitable.
And this right here, this is the magic that ties it all together. It's called the Flywheel effect. And the idea is actually pretty simple, but what they're doing with it in banking is frankly revolutionary. So you might come to SoFi for just one thing, maybe a student loan. But once you're in their world, their ecosystem, you see everything else they offer. And every new product you add makes you way less likely to leave. Best of all, it costs SoFi almost nothing to sell you that second or third product. That is a seriously powerful economic engine.
So with that whole business model in mind, let's dive into why the bulls are just so fired up about this company. The argument isn't just that they're growing fast, no. It's that they're building a fortress with a deep, sustainable, competitive moat around it.
The whole bullish argument really boils down to these 3 key points. First, that flywheel thing we just talked about, it isn't just some cool theory on a PowerPoint slide, it's actually working. Second, they have a massive structural advantage, a real national bank charter. And third, they're successfully shifting into those more profitable, less capital-intensive business lines. So let's look at the proof.
This number, this is the key to SoFi's single biggest advantage. See, because they have a real bank charter, they can use their own customer deposits to fund their loans. That's incredibly cheap money. This one thing saves them an estimated $552 million a year. That's compared to their competitors who have to go out and borrow that money at much, much higher rates. This isn't just a tiny edge. It's a massive, durable moat.
And here it is, the proof in the pudding that the flywheel is spinning. Almost a third of all new products are being picked up by people who are already SoFi members. That is huge. It shows that once people get into the SoFi ecosystem, they tend to stay, and they use more and more stuff. The strategy isn't just talk, it's delivering real, measurable results.
Okay, but it's not all sunshine and rainbows. We have to look at the other side of the coin, the bear case. It raises some pretty serious questions about SoFi's financials and, whether the stock is just way too expensive for the risks that are involved.
And this right here, this is the question that's at the very heart of the bear case. SoFi keeps reporting that it's profitable based on standard accounting rules, GAAP profitable. But then you look at their actual cash flow statement, and it looks like they're just hemorrhaging money. So what is going on?
This is the number that has the bears so freaked out. A negative operating cash flow of over $1 billion. I mean, on the surface, that looks like a massive flashing red flag, right? It looks like the company is just burning through cash at a rate that is completely unsustainable. But this is where the story gets really interesting.
So here's the twist. This isn't really a business problem. It's more of an accounting thing. You have to remember, for a bank, the main business is issuing loans. And when they do that, it actually shows up as a negative on the cash flow statement. So that $1 billion loss of cash, it's really SoFi putting money to work by investing in new loans, the very assets that are going to generate all their future profits. It's actually a sign of rapid growth, not a sign of failure.
Now, the other big risk for investors is the valuation. Just take a look at this chart. The really important number here is the price-to-book ratio. It basically compares the company's stock market value to the actual value of its assets on paper. SoFi trades at a ratio of about 4.6. Now compare that to a solid digital bank like Ally, which trades at a ratio of 1.0, right at its asset value. That is a huge premium for SoFi, and it means the market is pricing in a whole lot of future success.
And this slide really gets to the heart of the whole valuation debate.
The market is basically treating SoFi like it's a disruptive Silicon Valley tech company, not like a bank. And what that means is investors are betting on them executing their plan flawlessly for years to come. There is very, very little room for error here. If SoFi stumbles, even just a little bit, the stock could get hit hard.
All right, so you've got the bull case, a fast-growing company with a real, powerful competitive advantage. And you've got the bear case, a sky-high valuation that basically demands perfection. So, after looking at all of this, what's the final verdict from the research?
Well, here's the conclusion. The research we analyzed ultimately lands on the side of the bulls. The argument is that the company's core strengths, that incredibly powerful bank charter and the flywheel effect that we can see is working, are just strong enough to overcome those valuation risks. Hitting sustained profitability was a massive milestone because it basically proved the whole business model actually works.
So what should you be watching for next? Well, in the short term, it's all about execution. They've got to hit their earnings targets and keep getting users to adopt new products. Longer term, the real test is whether they can truly scale up that technology platform and prove out the mature economic power of their customer base. These are the milestones that are going to decide if the bulls were right all along.
And so that leaves us with the big question, right? SoFi clearly has a powerful business model and this grand vision to become a true financial empire. But it's also a high-priced stock operating in a really tough cyclical market. All the pieces are there, but any number of things could knock them off course. I guess only time will tell which side of this argument ends up winning out.